In this pincast, I am going to review Chapter 6. It's Part 2 of my pincast, and it's going to deal with the calculation of cost of goods sold. Let's hope I get this right, because there's a lot of math going on in this one. The first thing I want to do is share some facts with you, and then we will use those to calculate cost of goods sold using FIFO, LIFO, weighted average. I think you'll just understand specific ID when we're done, so I'm not going to worry too much about that one. I'm going to put you on hold and pop in some numbers. It's actually called a pause and pop. So hold on and I'll pause and pop on you. Let's look at our facts. I want you to notice we have beginning inventory, 10 units for $15 each at $150. Then I noted that we had a sell in here, 3 units at $20 each, and that sell would be $60, but it doesn't really come into play other than to let you know how many inventory units left under a perpetual system. We have a purchase, 8 units, $18 each for a total of $144. Then we have another sell of 9 units at $20. That would make our sell be $160. But again, that's only useful for making the income statement. Then we have another purchase of 4 units at $20 each. And that's $80. The sell at $525 equals $125. Let's focus on just the inventory and the purchases right now. Things marked with a check mark. We have a total of 22 units. And the total price of those units was $374. If you add up, if you do things from totals then, I'm going to put this in a different format, one that might look to you like what we did when we did the periodic method, but I'm staying with perpetual here. We had beginning inventory, the amount of $150, and then we had a purchase, our first purchase, which totaled $144. Then we had another purchase, which totaled $80. So our total available, as you can see, was $374. What I'm trying to do is say how much of that is in ending inventory, how much do I still have on hand, and then the difference will have gone into cost of goods sold. So our objective is to figure out what's ending inventory, and if you take your total available and subtract what's in ending inventory, it will leave you with cost of goods sold. This is how you calculate these two numbers with the periodic method. And we're not using that to calculate them, but we're keeping them in that format because I want you to be familiar with this basic cost of goods sold formula for future accounting classes, and it will help us understand what's to come below. One more thing I want to point out to you is where we are in sales. In this example, I showed you the sales. We have a sell of $60 right here. And we have a sell of $180 in our backs. That would have been recorded in sales. Then our final sell was for $125. So our total sales in this example, the whole time, is going to be $365. So what we're trying to do then is figure out what our income statement is going to show. We're going to have sales in the amount of $365. From that you're going to subtract cost of goods sold under FIFO, LIFO, and weighted average, and come up with gross profit. Now we'll talk about the differences. We don't know what these are going to be until we work through, but this is what's going to go on the income statement. And you do have a choice. When you use FIFO and LIFO and weighted average, it's going to affect how much is in cost of goods sold and how much is in gross profit. So, you ready? Let's get started with FIFO. For this discussion, I'm going to use an inventory T account. I think that helps. I've drawn one here for us. And as you know, in inventory, perpetual purchases are recorded as debits. Cost of goods sold are taken out as credits. I'm just going to calculate what's an ending inventory using a T account and do it an item at a time from the information above. I'm only going to total when I need to, because you don't need to do a lot of math under FIFO. Certainly not as much as you would do under LIFO anyway. So let's pick up our beginning inventory. In our beginning inventory, we have 10 units at a unit cost of $15 each. That's in our beginning inventory right here. Put a check mark next to it. That's where we start. And the first thing that happens is you have a sale. You sell 3 of those units. So 3 of those units are going away at a cost of $15 each. So cost of goods sold for that sale is going to be $45. So if you had 10 and you sold 3, you now have 7 left at $15 each. We don't have 10, we have 7. We sold 3, and next we buy 8. So now we have in our inventory 7 units at 15 and 8 at 18 for a total of 15 units. We just picked up this purchase. Now we sell 9. Well, which 9 did we sell? First in, first out. Say the first to go would be 7 at $15 each, and these are now gone, so there's none left. And we need to get to 9, so we'll take 2 more at $18 each. And if I sell 2 of those 8, there will be 6 left. So I'll have 6 left at 18 in my ending inventory, and you can see I sold 9. 7 times 15 equals 105, so that's part of the cost. 2 times 18 equals 36, so that's another part of the cost. So the cost of goods sold for this sale is going to total $141. My second cell is done, and I think I need to make this longer. It's going to be hard to get all on one page. Not sure I'll make it. Where are we? Let's see. We just finished this cell of 9, so now we have our next purchase of 4. So we purchase 4 more at $20 each. So in inventory I now have 6 at 18 and 4 at 20. And my last sell happens. I sell 5. Which 5 did I sell? Well, if you're going first in, first out, they all are going to come out of that $18 batch. And there'll be 1 left of those at 18 and 4 left at 20. And I will have sold 5, and their cost will be 18. 5 times 18 is 90. So there's the cost of that sale. I think we're ready to see where we ended up. What do I have in ending inventory? Well, I have 1 unit at $18 for a total of $18. And I have 4 units at 20. 4 times 20 equals 88. So I have a total of 4 times 20 equals 80, huh? Pay attention. 80 plus 18 is 98. So in ending inventory, I have $98. So there's my ending inventory balance. And in my cost of goods sold, I have 45, 141, and 90. So that totals 276. So using FIFO, then let's apply that to my basic cost of goods sold formula. From above, I had beginning inventory of 150. Then I had two purchases, one at 144 and one at 80. So my total available, we agreed, was 374. Add all of those up. And I'm telling you, my ending inventory is 98. So my cost of goods sold in this example would be 276. And if you do the math of this, you can see that it worked when we did the detail, and it works in total. So then, how does that look on my financial statements? Well, I have on the income statement sales as calculated from above of 365, and my cost of goods sold is calculated both in the T account and in my analysis is 276. So my gross profit as it relates to FIFO would be the difference. 365 minus 276 is 89. So that's how much I have of gross profit on the income statement. And on current assets, my balance sheet, I show inventory at an amount of $98. These are just facts. So gross profit under FIFO would be 89, and ending inventory on the balance sheet would be 98. Wow, that was a lot, huh? How about we try that whole thing again, but this time we use LIFO. Hold on. Let's start getting some numbers in. I'm going to go back to our basic facts. Our beginning inventory, we had 10 units at 15, so what was that? Don't really need to keep track of costs on LIFO, so I'm not going to do a bunch of math I don't need. Then I sell 3, using the facts from above, line at a time. If I sell 3, they're going to come out at $15 each. Remember, everything happens at cost in inventory. And I will have 7 left at 15. Then I purchase 8. 8 at $18 each. So now I have 7 at 15 and 8 at 18, and I sell 9. My first sale costs $45. What will my second sale cost? Well, the last in's the first out. So of the 9, 8 are going to come out at 18, and that layer will be totally gone. And I'll have 1 more to come out to get to 9 at the old price of 15. So now there's not 7, there's 6. 8 times 18 is a cost of $144 for those 8. 1 times 15 is 15. So the total cost of this sale using FIFO is $159. Let's move on. The next item was our purchase of 4. So I purchased 4 at $20 each. Now in inventory, I have 6 at 15 for my original. The next layer's gone, and 4 at 20. Now I sell 5. Which 5 did I sell? Well, 4 is going to be at $20 because those are the last ones in, and that layer is completely eliminated. And 1 is going to be at 15. So instead of having 6, I now have 5 left. 4 times 20 is 80. 1 times 15 equals 15. My cost of goods sold in this case is 95. I'm just not going to make this one-page thing, am I? Maybe. We'll see. So where are we? In ending inventory, EI, ending inventory, I have 5 units at $15 each. 5 times 15 equals $75. So that's what I have in ending inventory under LIFO. And in cost of goods sold, I have 45, 159, and 95. So cost of goods sold is totaling 299 using LIFO. Let's take it over to our basic inventory format. Our beginning inventory, I know it's boring, but we're going somewhere with this. It's 150. We had 2 purchases in total. I'm only doing dollars, not numbers. First one was 140. The second one was 80. You can see from my basic facts. My total available, which agrees with our facts, is 374. In ending inventory, I have 75. So my cost of goods sold in this example would be $299. Calculated kind of from a periodic approach, but agrees with what we did in our detailed T account. So under LIFO, the sales amount wouldn't change. It's going to be $365, but our cost of goods sold, calculated 2 different ways for you, was $299. So what's our gross profit on our income statement going to be? It's a good question, isn't it? Our gross profit on our income statement using LIFO is going to be $66. Less than using FIFO because we're costing out more expensive stuff. And on our balance sheet, inventory, the account balance, is going to end up being $75, shown both ways. So our current asset inventory is less. When your current assets are less, you simply don't look as strong. So you could say FIFO makes you look better as far as net income and current assets go. And LIFO makes you have less net income. Bonus of FIFO makes you look better. Bonus of LIFO saves tax dollars. Some businesses don't care what net income is. They don't have to show anyone except the banker and the IRS, and their objective is to save the tax dollars. They can tell the banker why their numbers are lower. They can put it in their notes. Some people just need their financial statements to look good so they can borrow money, lower rates, and attract investors. Guarantee you, they're going to try to go with LIFO. Weighted average is up next.